Hello everyone, welcome to another session on something very interesting happening in the global currency markets. I want to show you multiple charts today. So let's start with the Fed Watch tool. The Fed Watch tool gives an indication of what is the probability of interest rate cut by the US Central Bank, the Federal Reserve, in their next meeting. It actually gives an insight for the multiple meetings in the future, but what is most critical is what is the latest upcoming meeting. And all of us are aware that the latest next meeting is going to happen on the 10th of December, and this chart shows the probability of a rate cut or whatever cut, either a static increase or a decrease, whatever it is, what is the probability for the next rate cuts. It will also show you a table below. You can have a look at it. You can zoom it and have a look at it. It also shows the how the probability has moved in the last few days, a week and a month, and that is where it gets interesting in this week and in this month as well. Okay, so remember the current interest rate is around 3.75 to 4%. That is the Fed funds rate. That is the current status. Okay, and we are looking at this particular line which shows a 25 basis point cut and how that cut probability has changed in the last few weeks and a month. You know, 1 month back on 14th of October, the probability of that rate cut on this line, okay, was 94%. Okay, the rate cut probability 1 month back for the 10th December meeting was 94%. Then just a week back it came down to 67%, and now it is at 49%. See, this is the rate cut probability of 25 basis point, and this is the probability that it will remain the same, which means now it is equally divided between the market anticipation. Okay, so 94% probability of a rate cut in December meeting just about a month back, and now that has become less than 50%. So it is less than 50% chance that there will be a rate cut on the 10th of December by the US Central Bank. Okay, this is actually very critical for global forex markets. I'll come to some of its effect in the later part here. So let me also show you another very interesting part. Now that rate cut expectation, since it has changed, it will have a big impact on the US bond yields, and it has had an impact on the European bond yields as well. Obviously, European bond yields will be impacted by some other factors, but US bond yields predominantly a very big impact comes from the changing expectation of interest rates. So I will show you what has happened. So there are 4 lines here. This red line, this one is the 10-year US yield scaled on, sorry, this red line I think is the 10-year Europe yields, okay, and it is scaled on the left y axis. The light red line is the Euro 2-year yield scaled again on the left y axis. The dark blue and the light blue are the US yields which are scaled on the right side. Okay, so this is the left side which shows European yields. This is the right side which shows US yields. Okay. Now US yields are blue, dark blue and light blue. This is 10-year, this is 2-year, and European yields are the dark red and the light red. Okay. So if you look at it, let me just clean this up. Okay. If you look at it, all the yields have gone higher. Okay. Let's first look at the US yields. US yields have gone higher. Okay, and it has gone higher by almost 4.5%. Okay, that is around 18 basis points. 18 basis points is quite a lot. 4.5%, all of us know it's quite a lot. So 10-year yields have gone up by 4.5%, and the 2-year yield has gone up by almost 5%, the blue lines. Okay, so that is the reflected from, that is getting directly reflected from changing interest rate expectation that I showed on the Fed Watch tool. Surprisingly, if you look at the European yields as well, European yields have also gone up by around 3.5 to 4%, both here. Okay, so there is a lot of expectation change, interest rate expectation change, and that is getting reflected in the yields. Remember, if US yields go higher, and European yields also go higher, then the markets will look at the relative change, which is growing faster. And the way it looks like, US is, the yields are going higher at a slightly faster pace than the European yields. So the dollar index, the dollar will derive strength from it. Okay. Now, what does that come to finally for exporters and importers in India? Okay. I have talked extensively about dollar INR in the last 3-4 videos. So I thought might as well look at the Euro INR chart. There are a lot of people have called up asking about euro, because we have seen, how euro has gone up from 90s, okay, 94, 95. We have seen in the last 5-6 months how euro has gone up from the 90-95 range to 100 plus range, and it even went as high as 104, 105 here. Okay. So in this time, the importers had a very terrible time, exporters enjoyed, importers had a terrible time. But what happened was, then quickly there was a decent fall of about almost 4.5, 5 rupees from 104, 105 to 101, 102. Okay. Now here is the place where a lot of exporters panicked and had called me and were asking about various ways how to hedge. I will tell you how to do it. But now see what has happened. Okay. It has gone higher again by around 2 rupees. Okay. So euro is around 103, 103.50. Now if you look at history, we are still very close to the all-time highs. Okay, 104, 105 was the all-time highs. Now it is around 103, 103.50. You should hedge European exporters or Euro exporters, I mean Indian exports to Europe. You should certainly look to hedge around 103 plus. Remember, there is a 4% annualized forward premium that comes to around 35 to 40 paisa per month. So if you do a 6 months forward, you get 2 rupees forward premium. So forward premiums are very attractive. Euro exporters should certainly look to hedge their receivables. Now what happens to importers? Now they've had a terrible time. Euro had gone higher by 10-12% in the last 7-8 months. So times are very bad for them. You can look for some bit of a corrective reaction to 101, 100, 101. I think you should certainly look to get levels around 101. Okay, so those are the levels for you to look to hedge short term. I wouldn't recommend hedging long term, but you can certainly look to hedge short term liabilities if euro comes to around 101. Okay, now if you are in a better or a worse situation, obviously you can reach out to us. We'll be always there to help you. But euro exporters, good forward premiums, very high spot, capitalize on it, and European euro importers should look or can hold on for a while and look at lower levels to hedge. So that is it from my side. Have a great weekend ahead.